Three, two, one. Hey guys, it's Andres
And Kevin here.
and welcome back to Brick by Brick. In this episode we're going to talk about building credit and why you need to have a credit score that's actually halfway decent to be able to invest into a lot of stuff. But yeah, a lot of the bigger uses for having a credit score, it's like when you're looking to buy a house, whether it's a house to live in yourself with your family or an investment for the future, an investment property. Looking to rent or even looking to start your own business. What other things do you feel like is important to have a credit score for? What has it worked for you?
So basically, when it comes to credit score, and I am pretty sure you've dealt with it, things that you might need it for is, for example, a house, right? So everyone has to live somewhere, and if you're planning on getting a house, then you definitely need a good credit score because you most likely you don't have the money to buy it in full, to pay it in full. So you'll need a credit score in order to to qualify for a loan in the first place. And the better the credit score, the lesser the interest rate, which means more money in your pocket. You are a homeowner. How would you explain that to someone? Or why is it important to own a house?
I think just having something for the future because like for example, houses on average they gain every year between 3 and 6% of their value. So that's an investment. Rent's an investment, like what you're getting out of it. It's an extra ROI that you're getting.
Would you say a house is a good investment?
Yeah.
Yeah.
Yeah. 100%.
How so?
That's a good question. I think just to the premise that you're getting more money than you put into it in a lot of the cases at the end of a long period of time. Right now it has not been a good investment. Like
Long term.
I've lost, but the amount of gain in the future that it's gonna get probably going to help. Yeah.
Yes. I feel like if you want to be successful, and I'll just use an example. It's like your base, almost. I want to say, it's like where you go back to rest and basically do all like your everyday life, so that you can go out in the world and be yourself. I'm not a homeowner yet, at least, but I do want to be, and I feel that's how I like to think about it. It's like that's your base, almost. Like that's where you'll eat, sleep, and pretty much hang out. So you can attack the world. Now, another point on why having a credit score is very important is renting, and this one I'm expert on because I'm renting right now. Basically, some apartment complexes won't accept you if you don't have a credit score. So if you don't have a credit score, and if you don't have a good one, they won't accept you, so you won't be able to rent. Essentially, you'll have to go through pretty much outside of actual good properties. And usually good properties do, or I guess renting places, apartment complexes do require good credit scores. But if you don't have that, you'll have to either rent with like people who don't check like your credit score, which is not the best thing. I guess in terms of security, because you'll know that they could just evict you or something without you knowing or something. But it's very important to have it. But what would be?
I want to ask you, like I've never rented before. Can having a good credit score help you like get a lower payment on a house?
I think it can. It depends on the apartment complex.
Yeah.
In most cases, I don't think it matters because I already have like a set price on their
Maybe
website.
like the cheaper it is, the better credit they require. Sometimes if it's a like decent place to be in.
Yeah, there you go. Yeah, it can be competitive at times. Because there could be like multiple applicants for that one apartment if it's a good apartment value wise. And if you're the one with the best credit score, then they're gonna look at you a little better versus someone with a lower score. Does it affect it directly? I don't think so, because they have already a fixed amount on like a website or something that you're applying for. But you're
Maybe like in terms of quality.
For sure.
quality. Okay.
But if you have like a, for example, if you have like a 400 credit score, then you probably won't be able to even apply for it, or you'll be denied. Versus if you have like a 800 credit score, well, they'll accept you. It's more of a like either you're accepted or not.
Okay.
Not really.
Like
Prices,
just increasing your options in general.
basically, it's a broader market for sure. But yeah, what would you say what's another thing that you need credit score for?
I think looking to start a business is a big thing. A lot of business owners, especially at the start of it, end up needing a business loan. And like when I don't know exactly because like I've never done this, but from what I've heard, when you open a business and open a credit line, like your personal credit score is basically co-signing for the business. I don't know if that makes sense. And just so that like it gives you more leverage to like actually be able to push it through, because a lot of like that a lot of the businesses, I think they fail in the first 5 years of them being open. So that's just an extra point of being able to push even a little bit further, even like get a little bit more of that luck.
For sure. How I see it is basically if you have like a, I don't know, lawnmower business, right? And for whatever reason, you need to upgrade lawnmowers. I don't know, I've never done that, but you need to upgrade lawnmowers, right? You know that by you upgrading that, you get a better ROI, return on investment, versus if you just keep working with that, that's when the loan would make a lot of sense. And in order for you to get the loan in the first place, you need to have credit. And the better the credit, the lower the interest rate, so the bigger the ROI, the return on investment. So you can use that loan to make even more money.
Yeah, but I think the most secure like use of a credit score is buying a house.
Yeah,
that's super secure. That's like one of the biggest reasons, because it's a secure investment. Like properties go up in value, properties get you paid more, and a lot of the time, just like you can always give a bigger down payment.
That's true. The better the credit score, just the less you'll pay in the long term, because the lower the interest rate. But some things as well that a lot of people don't consider or that don't know is I used to work for car insurance, so I know we used to actually work for car insurance, so we know this, but a lot of people don't.
I forgot about that.
Yeah, same I did. I did the same thing, but then I was like reading at it, I was like, oh, should I know this? But some third parties, things I guess that use credit is like insurance, car insurance. It depends on your state. I believe California doesn't use this method, but I know in Texas we do.
Do you think is it just certain insurance companies, or is it?
No, I think it's all insurance companies. I think it's a legal thing in the state of California. But basically, is if you have two people that are applying for the, let's say, insurance with, I don't know, whatever carrier, if they're apart, like they both have excellent record, driving record, same age, same gender and everything, they're literally like both right here. But if one has like a higher credit score, then this one's gonna pay this versus the person with the, I guess, lower credit score.
Okay.
So, yeah, having a credit score can also have a high one, can also help you save money in the long run, especially if you live in those states that do require that credit score, basically. They'll save you money in the long run as well. What other things is there apart from insurance? I'm trying to think because I know there's more, but.
Me too, but it's a lot of the things that you can get a loan on, like your car or getting like furniture through a loan. They're like, it's not a good idea usually. It's all going to lose value. It's all going to cost you more than it would have if you just saved more. But I think a good start for your like credit journey and building that credit, I started with the secure credit. I used the Discovery. I don't know how you did it, but like that one pretty well. I gave a $200 security deposit, and a lot of the times, most of the like credit card companies, they don't let you get a credit card without credit, which doesn't make sense.
Doesn't make sense.
It's like everyone in the job market wanting you to have experience, but not giving you the experience.
It's like you're 20 years old and you need to have like
Yeah.
20 years experience, and like, well, how do I get the experience if I'm 20 years old? I'm already like working. So yeah, honestly, secure credit cards are very, very important in order for you to start building that credit, because that's how they'll basically judge you at first, right? It's how. Yeah, go ahead.
What I did with that, I gave a $200 payment, and it was held for 6 months. And then when the time period finished, they gave me that back, and I started having credit from that. It usually takes around 6 months from you getting your first credit line. And honestly, that's how it worked for me. And I started when I was like, as soon as I turned, I think I was like 18, halfway through being 18. And that's how I started building credit. I don't know, like, how did
So
you start?
for our listeners, sorry to interrupt you. It's like you gave the $200 that you were gonna use already, but then
Yeah.
they gave them back to you anyway.
So yeah,
it's pretty cool. I didn't know that.
I gave the $200, and I got a $200 credit line. I could use $200 on the credit card, and that's how I built credit. So I used the $200 and then I paid it back. And at the end of the 6 months, they gave me back my security deposit and just kept the card as is. Because they didn't need
I did not know that.
How did you start?
I didn't know they gave you the.
Did you do a secure card too?
No, actually, what I did was a credit builder with GCU, which is a credit union here locally. Basically, what I was doing is, and honestly, now that I think about it, I should have done more research, but that's why we're sharing our experience. It was like $100 per month. And then I would pay $100 per month for a year. And then I think after the third month, I could claim back whatever I had paid, and it would give me all of it back. But it was just to.
I'm confused.
So basically, you would make payments, right?
Yeah.
Payments. That's just all it
It's like a loan. It's like a little loan.
Basically, but you get the money back.
Oh, so you're
so
not.
once I make the 12 payments,
You're
I
not
get
getting
the
money. You're not getting money from them.
Mhm.
You're just like, they request money from you to give you credit.
No, towards the end of it,
Okay.
they'll give me the money back.
Okay.
Because they're making money off of my money. They'll give me the
They're using it
$1,000
to
back,
reinvest it or something.
but yeah, they're gonna make money off of it.
Okay.
So I'm making $100 payments every month.
Do you
and
know
then
what
at
a
the
tanda
12
is? A tanda that
Yeah.
they do in Mexico?
Yeah.
Because my aunt does that, and that's kind of like the vibes that it gives me.
Well, it's the
It
same
is
thing,
that.
except just a that doesn't help you with credit.
Except it doesn't give you credit. That's okay. That's cool.
Yeah, but no, yeah, you give for this specific location, and I'm pretty sure I could have found something better. Is so you give $100 payments every month, and then at month 12 they give you the $1,200 back.
So it was a whole year.
It was for a whole year, but you have the choice to either get the money back and the credit was already the credit history was already built, or you could have kept on finishing the loan and then they'd give you the money back. I think I didn't go the full 12 months. I think I requested.
You can get it before.
Yeah,
Okay.
you can get it before, and I think I got it like at month 8 or 10, I think.
Okay.
I was like, yeah, I don't want to do this no more. I want the money. I got the
I'm
money.
done.
I'm done paying this. It was a lot. And at the time, I was only making like $400 a week. That was very little.
That's your whole income.
Yeah, basically. Like a good percentage of it's like 20% towards
Do you
that.
do you feel like, because I know a lot of the people watching this probably like have not so good credit scores if they already do have established. Does that help your current credit score?
100%.
How?
How it helps it is basically by on-time payments. So the more on-time payments you have, the better. But let's say, I don't know, for purposes of the example, since you said a lot of people don't have good credit scores, I think most people don't. If you have like 1 or 2 missed payments, and you have, we'll say you have 2 missed payments, and you total your lifetime, you have 10 made payments. Let's say you're very young.
Yeah.
And that's gonna be like an 80% payback ratio, right? But if you make on-time payments and you make them all the way up to 100, now you have a total of 100 made payments. You still have those 2 missed payments. It's gonna be 98% of actually you paying payments. So you go from 80 to 98, and in credit history, that's pretty significant. How would you say the numbers are, or I guess the percentages are set up for?
I think we can go into that in a bit, but like right now with that, like with credit builder loans, does it go away? Like, does the impact on your credit go away after it's done? Or like, what did you see when you finished?
What do you mean, like?
Like, you know how it gives you one-time payments? Or I don't know. Does it, like when it closes out, when that loan closes out?
The payments stay on your.
It stays on your record.
On your
Okay,
record.
that's super cool. That's,
Yeah, it never goes away. Like once you make the payments, those stay like that forever. And this is with every loan. Every loan is like that. Even if you close a credit card that you had, I don't know, like 50 payments made on, that's gonna stay on your credit. It's just now gonna appear as a closed account. But the
Yeah.
payments will still be there.
Okay, so it only affects like in terms of current credit mix.
Correct.
Okay, and like another thing that I know that a lot of younger people can do, even if they're below 18, you can ask someone like your parents if they already have an established credit score to put you as an authorized user on their credit card. And like you don't have to use it, but it's going to help you start building credit even before you're 18. That way,
Ooh, by a lot.
by the time you're 18, you will already have something established.
100%.
Like it's a head start. Like it's like graduating high school.
It's like, yeah, basically. It's like graduating high school, but you already have a college degree.
Yeah, it's like the finance equivalent of that. But I think that's a really good way. Those are pretty much the only 3 ways to build credit without debt. Do you know anything else or anything else you want to know on that?
Yeah, I mean, touching back on the on-time payments is that's very important for you to keep those payments like aligned with the deadlines, because that's 35% of your credit score.
Yeah.
So if you have a bad ratio, or I guess a bad percentage of payments made on time, it's gonna affect 35% of your score. So if you have like, just to throw an example out there for the people who don't know, is if you have like a credit score that's 800, or yeah, we'll say 800, and then you miss like 2 payments, it can drop down all the way to like 700 or 650.
Even if you miss like one single payment, that
affects
that is a big impactful credit factor. Your on-time payments and your missed payments. And for example, I'm gonna give this example. I have 5 credit cards, so every month I'm making 5 on-time payments, right? If I miss a payment, it's a little bit less impactful than if I only had 1 credit card, because so let's say I have 1 missed payment and then I made 200 payments in the past. My ratio would be 199 out of 200, right?
Right.
And that's 35% of my credit score. So it's gonna impact me less than if I was just making 1 payment a month. It would be like 40 payments that I had made only instead of 200. Does that make sense?
It should. Most people, it's really simple. It's like if you miss 1 payment out of 100, then you're 99%, I guess, categorized to make that payment. You're in the 99 percentile. But if you miss 10 payments out of 100, then you're 90%. There's a 90% chance that you'll make that payment, and lenders will see that and be like, because the typical is, I believe it's like 98 and up is good, and then 97 to 95 is like fair, and then 95 and below is bad. No?
Honestly, I haven't.
I think
I never missed a payment, so I haven't seen it.
I have missed payments,
Well,
so I'm pretty.
Those stay on your record what, like
7 years.
7 whole years, which
Yeah.
is,
Very long time.
I think that's one of the biggest reasons of why it's so hard to recover from a missed payment.
Out of all the factors, is the one that's the most important, because it's the highest one that the ratio, I mean, it's 35% of your credit score, and there's not a lot that you can do once it happens. Like, for example, like I don't know, credit utilization. It's like if you have your credit, you used all of your credit up to 100%, you can always make payments towards.
You can always fix that one and they make it down. For example, like with your on-time payments, if you take one thing away from watching this is make your payment on time every month. Because that's going to mess you up. Missing one single payment, it can hurt your credit score, and it's gonna be super hard to come back eventually.
If you don't have the money to make it, but eventually in a couple of years you want to buy a house, ask someone for money. I don't care. Like, find a way to make that payment because it will affect you in the long term. You might not think of it, or that's what happened to me. That's why I missed it. Because I was like, well, I need my credit score right now. I think I can like use that money towards like something else. And now I'm like, I should have made that payment. I should have made that payment. But that's very, very important because it stays on your credit for 7 years. And when it comes
How
to
many years?
sorry,
How many?
7
All that?
7 years.
Make your payment, kids. Please. Please.
Good for you, for me,
Good for you and do it for me.
do it for us.
That's super really good for us.
And then, how do you think revolving credit utilization affects your credit?
It also impacts you a lot, but it's a lot easier to change. But so your revolving utilization is every time when your statement closes, what percentage of your cards is being used. So if your credit closes and you're at less than 10%, that's considered really good utilization. You don't keep a balance. You're paying it before it's like on your statement. Like you're paying in full. Everything that you use, you're actually making the payment and you're just using it as a tool. I think revolving utilization is a really good indicator of how good you are with credit cards.
Basically.
Because if you have a super low utilization, you're not ever going to pay interest or not a significant amount at all.
Yeah.
I don't know. If
The
that makes
higher it is, the more you're giving your money away for free. Because you'll eventually will have to pay those if you want to be, if you want to have a good credit score.
100%. I think with revolving utilization, it's really important because it's 30%. It's almost as much as the on-time and missed payments. But let's say 1 month you just have the 60% utilization rate, which is super high. You use 6,000 out of the 10,000 credit limit you have. And mind, this is across all of your possible credit cards. If you have that, and then you end up paying it all in 1 month, and you don't even pay interest on that, your credit scores are going to go right back to being good again. So that's why I say this is super easy to fix if you have the means to do it, but it's still a really big contributor in the moment that it's high. I don't know if that makes sense.
100%. Yeah, the higher the utilization is, the worse. Because again, you're putting money in the pockets of credit card companies, and you're affecting your credit score. And I'll apply this like scenario towards why you need one of these is, for example, if you're trying to buy a house, and at the time you have your credit utilization is, we'll say it's like 1%, very low, right? Let's say you've been consistent with not putting anything on your credit card, and then you're applying for a loan, right? And since you're applying for a loan, they'll take a look at that. But let's say that you have an emergency and you have to use 50% of your available credit utilization. By the time you apply for that loan, they'll see that and be like, oh, okay, we can't give him a good interest rate because he has a 50%, credit score, or what do you say, 50% credit utilization, because your credit score will, I don't know if it's at 800, it will go down all the way to like probably like 700 or something very low. So that's why you gotta make sure you have that in check. And what you say?
I think it's super important to not this is how you see if you're putting money on the card that you don't actually have, which you should never do. Like if you're putting something on a card, it's because you can pay it cash at that moment. If you have a high utilization and this is a big no-no, like using cards to go get food that you couldn't afford, or even trips or vacations, putting vacations on a card when you don't have the money for that can be super bad for you, especially Because one, it increases the likelihood of you not paying it, it increases the likelihood of you paying interest to the bank, and then increases your utilization, and basically ruins the whole reason why you even got a credit card in the first place.
Exactly. If you're gonna have a high utilization, sorry, that will say a lot about you. That means that you're using a lot of your debt to pay for stuff. And that's not a good thing. You should always have it below. I know a lot of credit companies say below 30%, but I think it should be below 10%. That's really the ideal.
Below 10% gives you the best credit score anyways, so that's just...
I guess just companies say that so that they have something revolving, you know?
Yeah.
Something that makes them money. I personally believe that. I don't know if that's true, but I believe that. What other
I think
factors?
I want to make a really big point first, just because a lot of people think that revolving utilization is what you're getting charged interest on, which it should not be. It should be what you have before your statement closes. You should always be paying everything in full before it starts charging you interest. Because any kind of debt on a credit card is going to be bad on you if you're actually paying the bank for it. Like if you're paying interest, you might as well just do debit cards.
100%.
I think that's a big point. The next indicator of your credit score is your total credit length. Like how long have you had credit for? And the average length of your total accounts. That's about 15% of...
How has that affected you, or how do you feel like that will go on about in the future?
Ask that again. I did not understand the question.
How has that affected you? How has it?
I think because I started super young. Right now, I'm about to hit 4 years on my credit length total. And just starting young puts you so far ahead of a lot of people. That's why I think if you can get placed on your parents' cards as an authorized user, that's going to be a super big start because
Doesn't that like link it with your parents' like history, like time wise? I think it does.
don't know, but let's assume the worst case. Let me see actually.
I'm pretty sure, I'm like certain of it, that they did that once you link it with your parents or your cosigner, whoever it is, I think you'll get that no, I thought you were gonna. Okay, but let me do it. But I think that they'll take his credit age and apply it to yours, because you're like piggybacking off of their credit. I think. I'm gonna actually check this real quick. I don't know if you wanna mention something else.
Yeah. So let's assume the worst case scenario. Let's say you get placed at 16 as the authorized user and it only uses that. By the age of 20, you're already going to be where I am at 22. And I don't know the average length of my account because I have 5. It's probably lower than that. It's probably like at 3.5 years or something like that. Let's say I've had my first card at 4 years, which I have. And then the next one, I opened it right now.
Right.
Like my credit score would tank because my average age, one's at 4 years and one's at 0 years. It's gonna drop down to like a 2-year average length. I don't know if that makes sense, but that's gonna hurt your credit score a little bit. But for example, me, what I did, I opened my first 3 cards in the same year because now if I open a new card, instead of affecting half of it, it's only gonna be a quarter of what is my average credit length. So yes, opening new cards is going to drop it, but also opening new cards at the beginning, the sooner you open them, the more it's going to help you if you plan on opening one in the future. I don't know if is that a little confusing the way I said it?
No, that actually makes perfect sense. And actually going back to if it does like affect the credit age, I just ChatGPT it, and yeah, it's confirmed. It is actually, I guess you get the other person's credit age. So if they've had a credit history for, I don't know, say 20 years because of your parents, right? Assuming there are. You get the 20-year experience. So they'll rate you like half a 20-year experience. 20-year-old credit history. So keep that in mind as well. So it's always really, really good, to have that. But what else would you say is like a huge factor when it comes to credit score ability?
I think the next one is total account and your credit mixes. Like that's 10%, so it's not that much. But if you have more total accounts, it's probably going to be better for your credit score because it shows that you can handle money. Like you're showing the bank that you can handle it. And this is only good if you're not paying interest on any of it. But I think right now I have 6 different total accounts. I have 5 credit cards and then I have the mortgage. And that helps a lot. Like having one installment loan, which is the mortgage, and having a different type of
What is an installment loan? Sorry to
It's when you're making monthly payments for something. Like not the credit card because that you're trying to pay it in full. But the installment loan is when you're like getting, I think for example the house is an installment loan, but say
What else could?
school debt, student loans are considered an installment loan. And then I'm gonna use this really bad example, which I don't recommend, but a car is an installment loan and furniture loans are installment loans.
I didn't know furniture loans.
I think so, yeah, because you make monthly payments. I'm assuming. Let me ask ChatGPT so I'm not.
What about a regular loan, like a personal loan, just for whatever, like if I use it for vacation or something, which is a bad idea.
Don't use it for
It's
vacation.
a bad idea. But let's say that I would use it for a vacation.
Let me see. I'm asking ChatGPT because I honestly don't know.
No, because you're actually. It sounds like you're right.
Yes, both of those are are installment loans. So they do help your total accounts and your credit mixes. So that's really good. That's one really good thing coming from 2 really bad things.
So 2 things are into that is the total account, so how many accounts you have, and as well as the credit mixes. So if you just have loans for like credit cards, then it's gonna be a little lower versus if you have like a credit card, a mortgage, and a car loan.
Yeah.
Like if you have those 3, your credit mix is like good.
It's going to be better. It's not necessary because it's just 10%, but if you're trying to get to like 800 sweet spot, yeah, you're gonna need some of that for sure. I think these are super small. I know that you've heard this phrase before. You heard the phrase, "Don't run my credit."
Yeah.
Do you know what you know why people say that?
Yeah.
Because inquiries in the last 12 months are going to be the last 10%. And these inquiries there's 2 types of inquiries. There's soft inquiries, which don't affect your credit. These don't count. You need to be very careful that you ask about this before you apply for a credit card, apply for even insurance.
Yeah, those are mainly used for like insurance, like you said, for basically for when they need to check your credit, but it's not for a loan. That's the best way I could.
Yeah, if someone's asking you for your social security number, ask if it is a hard inquiry or a soft inquiry, and you'll know. But so this thing that affects the other 10% of your credit score, it's if a company runs your credit, it takes into account the inquiries in the last 12 months. Does that make sense? So this runs your credit, and then it tells the banks or the credit bureaus that you're applying for new cards, like you're needing loans.
Yeah.
If you need money, you're going to be less likely to be approved for more money because you're probably going to use it in a bad way if you have multiple of these.
Basically, I want to touch again on
Yeah.
what, because a lot of people don't know what the difference is, but I just had to ChatGPT some examples. But basically, soft inquiries are used for background checks. It's something that I couldn't remember, but it's basically like when you're applying to a new job. Some jobs are starting to use credit as like a factor in getting hired, so that will be a factor as well.
That doesn't affect your credit score. Those don't.
It doesn't. Yeah, these are
Those are
soft
soft
inquiries.
inquiries.
They don't affect your credit score. Other ones are rental applications, so those are soft inquiries as well. Even though technically companies for like a lease. But no, those are soft increase, as well as, let's say that you have a credit card with Capital One, they're gonna do a soft increase check once you open that unsecured credit card. In 6 months, they'll do a soft increase to see how you're doing with your credit, so that they can see if you're approved for a lower percentage or higher available credit, and as well as pre-approval or pre-qualification offers from credit companies. Like if you wanna, I don't know, we'll say, basically to qualify for 0% interest on 12 months and stuff like that. Those are usually the soft increase.
I think one of the mortgage companies that I looked into, they did a soft inquiry, and then the other two did a hard inquiry.
Oh, so it depends. Yeah, you gotta always ask.
I did. So ask, because sometimes they don't need a lot of information depending on the kind of business it is. I think one of them that I went, like the one that did a soft inquiry was a credit union, compared it to like an enterprise level mortgagee.
Right.
That did the hard inquiry. So I think it really depends on the company's expectations of you and their size. So make sure to ask every time that something like that happens.
Yeah, basically the main ones are mortgages. Those will always, be hard increase, as well as car loans, because you're requesting to have money lent to you versus paying off something like a credit card, as well as, just like you said, student loans are very important. And then those are the three main ones. And then after that, if you ever want to like apply for something, they're asking for your social security again.
Yeah.
Make sure you ask if that's a soft or hard inquiry, because if it's a hard inquiry, it's gonna affect your credit, because they'll see like, hey, this guy's trying to apply for something. He's trying to leverage.
I think a good sweet spot is like one every 12 months. Like having one is not going to one hard inquiry. Like if you're applying to credit cards once a year, that's okay. That's not going to hurt you much. But down the line, maybe like the best is 0. Second best is 1. I think after 2, it starts like actually impacting you.
100%. And those are basically like the 5 main pillars, right? So it's like on-time payments, as well as revolving credit utilization, as well as total credit length and average credit length. Because did we talk about the average credit?
Yeah.
Okay,
We went into that.
And then total counts and credit mixes, as well as increase in the last like 12 months is usually. They say typically they last 2 years, but I think the effect is minimal. Like after the first year, I think they're like completely gone, but it's like very minimal.
AI that?
I'm pretty sure.
Watch. But I think the biggest takeaways from this are like make your payments on time before you start building interest and before the statement closes, so that your utilization stays low and you get the most on-time payments. Another big takeaway is like start as soon as possible. Start now. Like go get your parents to put you on their credit cards now. As you're watching this video, put this on pause and go do that, because that's going to open opportunities and open doors for you sooner. It's going to open them before, and you're going to have to wait less than other people.
Yeah. How I decided, because I'm a very indecisive person, so how I decided if I needed a credit card, or I guess credit, is I asked myself 5 things. So I want to have a house in a couple of years. Do I want to rent, like go out of my parents, because I was young and I was asking myself this, and as well as maybe possibly in the future, do I want to have a business? Those are the 3 main things that I asked myself, and I was like, okay, I need to have these in order for me to be able to get them. Because you can, it's just like you can't get them without the credit score. But
How'd you learn that?
How'd
you learn that you needed a credit score?
YouTube.
Yeah, YouTube helps a lot. I think that's also how I learned.
Stephen Graham.
Did you also start with that? I think we started with the same videos. That's how I learned, watching Graham Stephan on YouTube, and like everything that I've learned about credit score was from him, or now from ChatGPT on all this stuff that we're asking it. So like even today, I've learned new things. I've learned how credit builder loans work, which I had no clue that. Like I knew that that was a thing, but I didn't know a lot of the things that I
Because
learned.
you didn't need it.
Yeah.
You never needed a credit loan. Because if I personally could have, let's say I was able to go back and redo everything, how I would have done it would have been an unsecured credit card.
Yeah.
That's what I would have done. But since I don't know why it was easy for me to just call my credit union and get it from
That was also.
I think they
that was
offered
not
it.
that was not a bad option. You just had to
Bad
like. You input more money.
It was just more money put into
Yeah.
that, and at the time it was significant because it was like
Yeah.
was that like 10% of my income, which is a lot to just.
Were you living on your own already?
I believe so. Yeah.
Okay.
Yeah.
How'd you apply for a house without a credit score?
How did I apply for a house?
Or
without a
for
credit score?
an apartment.
It wasn't an apartment. It was actually through a friend of mine.
Okay, you were.
Yeah, it was.
Okay,
It was like
so-
a roommate. Yeah. So that's how I did it.
Okay.
And then I was like, I want my rental. Like, I want to have my own rent, like my own apartment. And then they were like, yeah, you're gonna need a credit score. And I was like, okay. Then that's when I started billing it.
Yeah.
Because of it was a need as well, but yeah, it was basically because of that. And yeah, just ask yourself those 3 questions, and then if it's a yes to even one of them, then that means you need to start looking into this now before you find out later that you could have done it a lot
Yeah.
earlier. And
I actually wanted to ask you, like, on that, where do you feel like you'd be if you hadn't built a credit score younger?
that's a good question. I mean, probably still with like roommates or something, because if I didn't have enough credit score to garner a rental, or even my mom probably. I'm 22, so I would have probably already been with my mom for a longer time.
Yeah.
But eventually, I would have been like, okay, I need to get a
It's
credit
time.
score.
That's good.
Yeah.
Because
So-
I know that it like changed my perspective on finance a lot.
Yeah. How did you like?
I'd be living with my mom.
So you were living with your mom already, and then what happened?
Like,
Like, what triggered that thought on your brain? Like, I should have a
Watching
credit score?
YouTube, I wanted to invest. I wanted to buy a house. I knew that like maybe eventually I wanted to buy a car, which like after learning.
Was it before you started making money or after?
It was before. Like I think I was still in high school and I didn't know what I wanted to go to college for. I just knew that it had to be money related. And then from there I found my first sales job and I started going to college and like I realized that that was a good way to make money and just investing in properties instead of going the traditional route for me specifically. But I wouldn't have a house without that. I wouldn't have basically just a house. But I think I would have missed out on a lot of things and just that opened my mindset.
Right.
Yeah.
100%. So that is why it's very important. But I feel like, yeah, everything sounds cool, but warnings.
Yeah. It's hard. Just pay your balance in full every month. That way you avoid paying interest because the interest on credit cards are absurd.
I think the average is like 29%.
Yeah, I think my lowest is 24.
Yeah, they're super high. So let's say that you have 1,000 in credit card debt. They're basically taking, if the average is 29, we'll just put it simple, just put it to 30%. You're basically giving them $300 a year because it's an APY. You're giving them $300 a year just for free, just for having them having borrowed you money out of those $1,000. You won't even know because they don't tell you, right? But that's how it works basically.
Yeah, which is crazy. I know a lot of people that like have gotten stuck with that and it just like it takes a good chunk out of your paycheck. Like paying what's 300 over 12.
300 over 12.
Yeah, like that's like $30 a month that you're paying every year, which like it's a small amount if you have $1,000 in debt.
Yeah, if you have 1,000, that's like kind of small,
But
but
I I don't know if you've seen Dave Ramsey videos. There's people that have $100,000 in debt, over $30,000 in
I
debt.
think the average credit card debt is like $4,000.
Okay,
Like, I know all the averages, but yeah, it's like it's $4,000. That's the
that's like
average.
$100 that you're paying extra a month in just interest.
Basically. Can we actually do the math on that? Like at a 30%
It's like
interest.
$90, which like that could be going into something.
It's actually $1,200 a year. So 1,200 divided, it's 100. I don't know. That's $100 that you're pretty much giving them for free.
Yeah.
Because that's just the interest. That's not even like the principal, right? You still have to pay the principal off.
I don't know if it works like that, but yeah, you're paying that on top of what you already owe. Which, if you're just making the minimum payments, a lot of times you're just leaving that debt there and just paying interest.
That's right. So if you're already like, if you have that amount of credit availability and you're still using it, then you're basically you keep paying them $100.
Yeah.
Unless you just strictly, do the monthly payments, then by the time you start like going down a little bit.
Yeah.
But if you still use your credit card to use for payments, then you're still making that money. But that is why you need to, have the lowest possible.
Yeah, and don't spend money that you don't have. I've actually had this experience. I made a mistake when I was like first getting into credit cards. I went on a vacation and I spent like $2,000 on a credit card that I didn't have. And nothing happened from that because I came back from the vacation and I started working my ass off and I just made it before my payment date. But I know that like I didn't have any bills at the time. I was living with my mom and I only paid for my vacation and my food and things like that. And if I was already leaving out of my mom's house, I would have struggled so much to make that back. But whether it be vacations, luxury expenses like a new car that you can't afford and you go into debt for that, or even designer things, because a lot of people like to flex their Gucci bag, their Louis Vuitton bag. That can cost you a lot more than what it's actually worth in cash if you just leave it there accumulating interest payments.
Exactly. And so, yeah, try and stay away from the lifestyle inflation. So if you get a credit card and you have like $2,000 of available credit, that's like the company saying like, hey, look, you have this amount of
No,
money.
no, thank you.
That you have this amount of money to spend for free, and you don't have to pay for it right now. You can just pay it later. But look, and that's how they hook you.
Yeah, that's
you
how
know?
they get you. They want you to pay it in 2 years.
A lot of people do the luxury stuff, but then there's some people out there who do it for a necessity. It's like if you don't have money, you need to pay like a light bill. You'll be kind of forced to put it on a credit card and
Act as if you didn't have it.
act as if
You
like
you don't have that money, you can't pay your
you
electricity.
either need to ask someone for money or try and find a way to get that money, because once you put it into the credit card, it's just gonna snowball. Every time you don't have the money to pay for a bill, you'll be keen to put it into the credit card, and that's not good.
It's like reverse investing into stocks.
Exactly. It's like
It's like getting compound interest, but except of getting it, you're doing it.
exactly. It's like you're investing money, and instead of you're investing $10, but you're getting $5 back.
Reverse investing.
Exactly. So it's really bad because of the interest rate, especially if you let it accumulate over the I think it's a month, right? It's like 30 days for the statement.
Yes, usually. So
It's
gonna be super confusing because I did not understand it for like 4 or 5 months. Do your research before you get the card. I was so confused the first 3-4 months that I had a credit card. So what happens? You get your credit card and you have a statement date, statement date, close date, and a payment date. So let's say today is the 15th of June. Let's say I get my credit card today, my cycle starts today, and then it closes on the 15th of July, right? That is my statement close, and whatever I spent from here to there, and didn't pay off, which I'm going to try to pay off everything before the statement closes, before July 15th. that's going to be my statement balance. My statement balance is what I have to pay before. Usually it's going to be like a few days before. So let's say June 13th, July 13th. No, because it closes July 15th, so it's going to be August. By August 13th, I have to pay the rest of that. If not, it starts generating interest. And I know it's super confusing if like you don't have a credit card yet. Listen to that again. Listen to that again because it's super confusing and it's super difficult and I hate it. I hate the way those things are structured because it like fucks with my brain. But you need to know that to be able to manage your credits. Just pay everything before the statement. If there's like $10, $15 on the statement close date, pay it before your payment date. Because after your payment date, it's going to be like start generating interest. So yeah, that's the best way I can put it. Do you have anything to add to that?
So basically,
yeah,
it's like you get this amount of time to pay that off, and this amount of time is a month. So today is June the 15th. So June the 15th to July the 15th. Then you get this other amount of time to pay that off. So it's from July the 15th to August the 15th for you to pay this amount off. Now, if you don't pay this amount off by this time, you'll get in the next month you'll start getting charged interest.
Yeah,
it's the best way I can put it.
I think you did it really good. I understood very well, but replay this 3-4 times because it's hard and it's going to mess with you.
And sometimes some credit companies, not every credit company, so this is what you spend on this month, then you're supposed to pay it off in this month. Sometimes they'll give you like a grace period for the third month for when you're supposed to pay it off. They'll give you like a grace period. They'll let you not pay that balance and it won't affect your credit. But if they don't have that grace period, you have to pay it on the second month. Otherwise, you're pretty much screwed.
Yeah, that's what
that will go into your credit.
But I don't know if you want to add anything else.
So we talked about
maybe summarize a little bit of everything.
Yeah, dude. Honestly, if you're in your 20s, don't prioritize vacations and being happy because you'll spend on your credit card just like he did, just like I did. You'll do that because it's very easy to just because you don't actually feel the physical.
They make it super easy to do.
It's super simple, especially with Apple Pay now. It's very hard, but I would just try my best not to spend what I don't have. If you have $20 on your debit card and you have like a credit limit of like 1,000 and you haven't put anything on that and you're going for dinner, spend those $20. Like don't spend on the credit card. Like, force yourself to spend just the $20 that you have. 100%. And don't put them on the credit card. And basically just I guess the main thing is like start as young as possible. If you said yes to the 3 first questions that we asked earlier, the 3 points, start young or start now.
Yeah.
There's a saying out there, it's like the best 2 times to plant a tree is either 30 years ago or today. So take that as you wish. Anything you have to say?
Yeah, I want to add one, like the other best time to plant a tree is 29 years ago. Because that's probably better than planting it now, but that was just a fleeting thought that I wanted to say. I don't know why I said that, I did not have to say that. But just like be careful with expenses because just from personal experience it can get super difficult and like the reverse snowball effect is super real because I don't know, spending money can get super easy, especially on credit cards. Just be careful with that. Everything's made to be simple now and it just becomes so simple. A lot of people don't even look at their bank account, their debit bank account before swiping their credit card, so do that. Budget because that's going to make you know what you're going to have for the month.
We have a video on this. If you want to take a look at that, we pretty much go into like budgeting and stuff, right?
Yeah, 100%.
I
think we have a bunch, 2 of them that are in budgeting, but
put them here.
Yeah, let's Like budgeting is super important. Make sure you know how much you're gonna make the month and how much you have spent over the month. That's gonna set you aside from everyone else.
Basically. And yeah, if you have any, I think we did pretty good. If we didn't, please tell us how we can improve. And we want to eventually get it to where we can share other people's perspective on anything financially related or self-improvement wise. Tell us how we can be better, and as well as tell us your story. And then we want to feature it in the next video if we still have to get our first one, but
100%.
you know, once we get it, I know we will.
We'll
Once we get the amount of people, we'll have a beautiful community where we can all work together to accomplish our goals and be the best version of ourselves. And yeah, so if you have any comments, questions, anything, just let us know. Put it down below.
Yeah. And tell us what you guys want to hear about next, because I think that's going to help a lot. We spent like an hour before this thinking about what we were going to talk about. I think the exact same as the whole podcast.
Yeah.
But yeah, I think that was it. Anything else you want to add?
That's pretty much it. Just let us know how we can improve, and if you want us to share your experience, just put it down below.
Dude, you want to start like posting these exactly Sundays at a specific time?
I think Tuesdays. We'll talk about Tuesdays.
Yeah, we'll figure it out. Like next episode, we'll have it ready. But
yeah, we'll set up
we'll set up a date so that like it can be consistent, because honestly I've been uploading it the day whenever we have everything ready. But yeah, we'll get it sorted out.
Sure.
We'll figure out a date, and yeah, that's everything from us. Be careful with your credit. Build it. Start now. Start today. Start yesterday.
and be successful.
Yeah. We'll catch you guys next time. Bye.